10-year Treasury yields are finally breaking lower under 4.5% today, falling about 10 basis points because of ISM Services PMIs. They came in not great today, almost contractionary. Specifically, prices paid in the service sector also plummeted last month. This is really reassuring for the Fed and for, well, the odds of Fed rate cuts coming later this year. Now, here in this video, I will go over all of this data with you. We also have some comments from Fed Barkin that are reassuring markets a bit. That's part of the reason why small caps are outperforming. Also have reverse repo amounts here on screen today, and they are just absolutely plummeting. Today's number is 78 billion. This is down from 4 days ago at 187 billion. So what this means is liquidity essentially is starting to dry up, and there is less excess capital out there in the system to absorb the reverse repo agreements. Now, this is the number one thing that will cause the Fed to stop quantitative tightening, to stop running assets off of their balance sheet, because the Fed can only run assets off of their balance sheet to the extent that the markets are able to absorb them. And we do have some precedents for this. In September of 2019, we had a reverse repo crisis where essentially people just did not show up for the reverse repo operations. This caused interest rates to spike, and the Federal Reserve then injected billions of dollars into the market to ease the strains. It says here the liquidity shortage. The Fed had drained 700 billion in reserves from the financial system by mid-September 2019. On September 16, 2019, banks and money market funds withdrew 70 billion in reserves to meet quarterly tax payments. On September 16, 2019, 50 billion in long-term treasuries settled, which put pressure on reserve constraints. On September 17th, so a day later, the overnight interest rate on repo transactions spiked to as high as 10%. And this essentially caused the Fed to completely pivot and flip-flop. We could take a look here on Sharp to what happened in September 2019. I mean, there was a lot of volatility around this moment, but it really caused a 20% rally in the S&P when the Fed started to inject this liquidity into the marketplace, when you stopped seeing the effects of some of that monetary tightening via runoff and balance sheet reduction. So if something similar happens soon, which it's starting to look like that from the reverse repo operations, that would actually be a very bullish catalyst for our markets. Now, we also have big news today from Fed Barkin. Fed Barkin says it's difficult to know the impact of tariffs, but the latest Fed dot plot showed they would be 100% positively, definitively inflationary. That is obviously commentary from Zero Hedge here. That is not what Fed Barkin said. And he's basically pointing out that now the Fed is starting to kind of flip-flop from the last dot plot where apparently all Fed members agreed that tariffs would be inflationary, to now the Fed saying, well, it's difficult to know the impacts of tariffs. Barkin confirms that he is still leaning towards cuts this year in 2025, and he says he would never take any policy move off the table, but hikes would require an economy that is overheating, which is clearly not what is happening in the economy right now. This morning, we did get the ADP employment change for January that showed 183,000 job ads, well above the expectation for 150,000 job ads. So that is good, a good sign for the labor market and potentially for the economy. But if we take a look at ISM Services PMIs, we were expecting actually month-over-month numbers to go up across the board. And that just did not happen. The headline number came in at 52.8 versus expectations of 54.3. It's not too often that we have services actually miss. So, that's kind of different, and a sign that the economy broadly maybe weakening. And considering services are about 80%, 75, 80% of the economy versus manufacturing being the rest, services data just holds a lot more weight than manufacturing does these days. Now, ISM Services business activity comes in at 54.5 versus expectations of 58.1. So that's like a plummet, okay, in business activity. Now, numbers below 50 are negative or contractionary, so you're not there yet. But headline ISM Services is pretty close, which is some of the weakest numbers we have seen in a while. Now, employment came in at 52.3 versus expectations of 51.3, so that's a little higher, not necessarily a bad thing. ISM Services new orders came in at 51.3 versus expectations of 54.1. So that kind of plummeted. New orders is almost negative. Not really a great sign for the services side of the economy, which again is most of the economy. And ISM Services prices came down to 60.4. Last month they were at 64.4 versus expectations of 64.8. So services prices really plummeted, and that is what helped cause the rally in bonds today. You guys can see 10-year treasury yields are down about 10 basis points to 4.41%. We're finally below that 4.5% threshold, and a lot of this has to do with the services prices paid that came in lower than expected. I mean, a 10 basis point move lower in 10-year treasury yields is a big deal. So basically what this means is investors are going out and they're buying the bonds. Odds of a Fed rate cut or a couple Fed rate cuts this year are rising. You guys can see here, Fed rate monitor tool shows a 16% probability of a Fed rate cut March 19th, but you're really pushing up the odds of rate cuts. One by June, it's almost a guarantee now. By June, you'll have a rate cut, but there's also a 20% chance of 2 rate cuts by June. May 7th, there's a 36.3% chance of a rate cut. So this was actually very positive news for the broader market today. ISM Services data was not that good. Now, tomorrow we're going to have some data coming out, a little bit of a slower day. On Friday, it's the big data with non-farm payrolls and the unemployment rate and Michigan consumer sentiment. Now, Fed Barkin also had other positive things to say as well. Fed Barkin says, I expect 12-month inflation numbers to come down nicely in Q1. He also says there is no evidence of overheating at this point. He says he still thinks the policy rate is modestly restrictive and have recalibrated to a place that is more sensible to where the economy is now, and the bias is to see what happens and react to it. And now dairy cattle have tested positive for bird flu strain not previously seen in cows, U.S. Department of Agriculture says in email seen by Reuters. And via the World Trade Organization, China has initiated a WTO dispute complaint regarding U.S. tariff measures. China did to some degree strike back recently, imposing 15% tariffs on coal and on LNG imports to China, and I believe 10% on crude oil imports. It might be 25% for coal and LNG. I don't think the numbers matter all too much because oil is a global commoditized product, so is coal, and so is LNG. Overall, when China did put these tariffs on, it caused a slight reaction in overnight trading, and then markets just resumed higher the next day. It wasn't as dramatic as Mexico and Canada, at least for our markets. You can also see that crude oil inventory numbers came in at positive 8.664 million barrels last week, where we were only expecting positive 1.3 million barrels last week. So people are really starting to drill. That is one reason why oil today is down about 2%, and the more oil falls, the less pressure on inflation we are going to have, the less of an impetus it will be for the Fed to keep rates higher, especially as you get more progress on inflation in the coming months. I think it's going to be obvious that the Fed is really going to need to start aggressively cutting rates. You can see in the broader markets, Russell 2000 is the outperformer today, up almost 1%. The NASDAQ is the underperformer, actually red, down 0.05%. S&P is up 0.14%. The Dow is up 1/3%. The VIX is absolutely collapsing today, down 6.3%. And again, some of that has to do with 10-year Treasury yields also falling 10 basis points. It makes sense why the VIX is down so much and the Russell is up a lot. CNN's Fear and Greed Index today is sitting at 39, so showing a lot of fear still in markets, which, I look at this as a purely contrarian indicator. When this thing is in fear, I think you should be more bullish. When this thing is in greed or extreme greed, it's time to be a little bit more defensive, okay? As long as this thing is in fear or neutral, history would tell you want to be bullish on markets. Market momentum is fear. Stock price strength, extreme fear. Stock price breadth is fear. Put and call options neutral. Market volatility is neutral. Safe haven demand in fear. And junk bond demand is neutral. Same is generally true for the percent of stocks trading above their 50-day moving average. You're up 3.61% today to about 51% of stocks trading above their 50-day moving average, but still, almost half of stocks are below their 50-day moving average. You don't really start to get overextended or so until you're like 75 to 80% of stocks above their 50-day moving average. You're really not even close to that at this point. And we will be getting a new AI investor sentiment survey that will be coming out tomorrow. Last reading was 41% bullish, 25% neutral, and 34% bearish, which is pretty much within historical ranges. Besides, the bears are a little high and the neutral investors are a little low. We did get a new Atlanta Fed GDP Now update today, since we did get exports and import data. And now we're sitting at a 2.9% GDP estimate, which is falling back closer to where the blue chip consensus estimate is, around 2.3% or so, after almost being at 4% for the initial read for Q1 2025 GDP. Now, you do have some earnings as well today in after hours. Ford, Qualcomm, ARM, Symbiotic, AMSC, Viking Therapeutics, O'Reilly Auto Parts, Align, and Aflac. Tomorrow morning, Eli Lilly, Roblox, ConocoPhillips, Peloton, Hershey, Bristol Myers, Tapestry, BCE, Yum, and Philip Morris. In after hours on Thursday, you have Amazon, Elf, or tomorrow, Elf, Cloudflare, Affirm, Fortinet, Microchip, Pinterest, Victory Capital, MPS, and Powell. So earnings season is not over yet. Now, as far as economic data coming out tomorrow, it's going to be the slowest day, really, for economic data. You have initial jobless claims, continuing jobless claims, challenger job cuts, a speech from Fed Waller at 2:30 p.m., and a Fed Daily speech at 3:30 p.m. tomorrow. So not much as far as economic data, but that leads into, again, Friday's non-farm payrolls report, the unemployment rate, and the Michigan Consumer Sentiment Report. That'll all come out between 8:30 and 10 a.m. in the morning on Friday. So let me know what you guys think about all of this information down below in the comment section. Are you bullish? Are you bearish? What are you doing in your portfolios? Let me know that information down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.